You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike TOSAW from RCM Asset Management, Andrew the Rock Lobster GIOVINAZZI from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it is time once again. The bat signal is up. You've called for us. We're back. Yes, it's time for the option block. You need us now, perhaps, more than ever, and we're here to hold your hands, walk you through, talk you through, analyze all this madness going on out there. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-exciting, ever-necessary in this market, Options Insider Radio Network. Trying, people having to self-isolate, remove themselves a little bit. Also, a lot of market turmoil. Good thing we got a lot of on-demand content for you guys to enjoy. The perfect thing to allay your fears, perhaps educate or excite or inform you in these stay-at-home type environments. Of course, you can get us live every Monday and Thursday, noon Central, 1 p.m. Eastern on this program. Got Twifo coming up a little bit later. We just recorded OPR. That'll be hitting the network very soon. Brian and his team talking you through some fun stuff there as well. So a lot of great stuff hitting the network for you guys. Sit back, hopefully relax if you can, and enjoy what we're sending at you. And, of course, however you listen live after the fact, keep those questions, those comments, those insights, those voices of concern coming. We do enjoy hearing from you guys. Maybe not so much these days because most of it is kind of hysterical, but still, on balance, we typically enjoy hearing from you guys. And joining me on the program today to help me walk you guys off these ledges. First off, we've got the man who's been prepping for this for pretty much as long as I've known him. That's why he's in a compound on the far-flung shores of these here United States. And right now, he's just waving his finger and saying, ha-ha, I told you so. He is the Rock Lobster, Mr. Andrew Giovinazzi from OptionPit.com. Mr. Rock Lobster, I mocked you for years for suffering the ravages of the clam pirates there on the shores of these fine United States. But now, sir, it seems like the tables have turned, and you indeed were the correct one, sir.
Although it gives me zero pleasure to say so, unfortunately. And as I figured, spring is around, because guess what was up? Who was up at 5:15 this morning? Poaching clams. The clammers are back out, so at least in the middle of nowhere in Maine, people are still living their lives, their cloistered little lives as usual. But quite an exciting show, and oh my God, quite a rebound when your listeners get to hear this. I just watched everything lift like. Anyway, we'll get to that.
Yeah, maybe they've announced some stimulus while we've been chatting here. Either way, global pandemic concerns, market meltdowns, not enough to spook the clam pirates out of their business. They're also not enough to spook Uncle Mike. He's here to walk you off the ledge, hold your hand, roll your puts for you, if necessary, of course, from St. Charles Wealth Advisors. Uncle Mike, welcome back to the program in this clearly totally an Uncle Mike type market, sir.
Hey, the markets are up 5%.
There you go.
From the lows.
There you go. We're talking it up. See, I told you. We're restoring confidence to the world.
CNBC just put a bulletin. Uncle Mike's about to speak. The markets went up. We need our permabull here. So I got all sorts of permabull stuff today. I'm wound up. I can't wait till it's my turn to talk today.
All right, then. Well, let's get to it. A little bit of the old trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, welcome to the Trading Block here as we break down what the heck was trading here. Looking here just to see what's turning. We got the Fed diving in now to announce what they're terming extraordinary funding actions in the wake of these big sell-offs. Of course, coming into the show here, we were seeing kind of just the tail end of madness going on out here, listeners. Most of the major indices, or all of them now, are officially in a bear market. Well, they were. We'll see how today closes. But the bull, I should say, coming into today was officially dead. Good run, 11 years. But at least it seems for the time being now, at least that has come to an end. The Dow reached it first back earlier this week. S&P and NASDAQ following later here this week. The Dow was at a record high exactly a month ago. Oh, how the worm has turned, of 29,551. And S&P hit this record high of 3386 about a week later on February 19th. Both of them now off about 20-odd%. Of course, if this rally holds today, we'll see how things are going. Speaking of, these are somewhat unprecedented times, so it always helps to put these things in a little bit of context. Our friends over there at Goldman doing just that, studying bear markets all the way back to 1835, and they're breaking them down into various categories: structural bear markets, cyclical bear markets, and event-driven. I guess you can guess which category we find ourselves in right now. Of course, the event-driven bear markets. And they say on average, these types of bear markets, things that result from some sort of external shock to the system, these have averaged about 29% decline. So if that holds true, we're in for a little bit more downside here. Of course, we've never really seen a virus, a pandemic-driven sell-off before. So these are somewhat uncharted waters from that perspective. The good news, if you look for the glasses half full version, the Uncle Mike version, the good news, bear markets triggered by these types of external shocks usually recover within about 15 months. So the sell-off is not that long-lived. Again, we don't know the nature of what we're dealing with yet here, but still interesting. Structural bear markets are something obviously has fundamentally shifted or changed in the economy. Those see drops much more severe, 57%. And your cyclical bear markets were kind of just the trending end of the trend, beginning of a new one there. Those see drops of in between, about 31%, a little more than the event-driven type sell-offs. Yeah, interesting things there. Again, we're kind of in uncharted territories, but still interesting. Also interesting, worthy of note, usually we've seen the ability for the Fed to have more rate flexibility going into these types of sell-offs. We've never really seen, again, while we're somewhat uncharted territory here, we've never really seen the Fed already have taken most of their action before the thing really even begins. Like I said, the Fed's chamber kind of empty right now, so that's also somewhat unprecedented here right now. All right, coming into showtime, we did see the VIX at about a 65. That puts it up about 12 handles. From last show, we were threatening 70 intraday at about a 69.10, I believe, is the high over there. That was earlier this morning as we hit the circuit breakers for the second time in a week. I have to check on that. I'm fairly certain is unprecedented. I'm not sure if we hit circuit breakers twice in the same week before, so I'll have to dig up some of the notes on that. VVIX, aka the volatility of VIX, up quite a bit, as you might imagine, as well, up to 154. That's up 11 points from last show. And our old friend VXX, clearly refusing to die these days, has pretty much already done its reverse split for the year. Doesn't need to do its reverse split. It already happened. It's up another 11 handles from our last show, up to 46 right now. So a lot going on. But I said, that news is perhaps about to change. We're seeing a lot of these indices paring their sell-offs dramatically. We were off over 7% on most of the major indices. Right now, that's been cut in half. It's about 3%. And now it seems like they're selling off again down to about 5.5%. So The Fed is stepping in some sort of still unknown, undetermined fashion, and that apparently buoyed the markets for a little bit, and then maybe now not so much. Of course, we're also on the tail end of a travel ban on Europe, which is somewhat unprecedented as well, and some people may be arguing a little bit too little, too late. Mr. Sebastian's buddy, Mr. Kramer over there, kind of losing his mind on CNBC. We'll get to that in a little bit as well later. A lot of you chiming in on that. But before we do that, let's go back around the horn. Uncle Mike is champing at the bit here. He's got to get in, so let's get him in. Mr. Uncle Mike, sir, crazy times. I was going to say your beer, I should say your bull is dead. Long live the bull. But who knows? Maybe if this Fed action has some teeth, maybe not so much. But still, what is your take on what the hell we're seeing right now, sir?
Well, let's talk about a few things. So the three areas of money with which I manage, I want to cover those real quick. Aggressive trading. I've been 99% cash for 2 weeks now. I've said on the show. Still have this butterfly that refuses to die because the volatility is keeping it alive. But that's 99. I'm 99% in cash roughly with that. For the hedging, I've had to roll my line in the sand once. That was this morning. And the fact that I've had to do that once in a 20% downturn, I'm very excited about that. What I want to address is the market in general. And I'm quoting Johnny Cash and his song Ragged Old Flag. It's a song about there's a ragged old flag, but this is the story about the flag. And this is ultimately the story about America. See, we got a hole in that flag there. When Washington took it across the Delaware, it got powder burned. The night Francis Scott Key sat watching it writing, "Oh, say, can you see?" It got a bad rip in New Orleans with Packingham and Jackson tugging at its seams. It almost fell at the Alamo beside the Texas flag, but she waved on through. She got cut with a sword in Chancellorsville. She got cut again in Shiloh Hill. There was Robert E. Lee, Beauregard, and Bragg, and the South wind blew hard on that ragged old flag. On Flanders Field in World War I, she got a big hole from a Bertha gun. She turned blood red in World War II. She hung limp and low a time or two. She was in Korea, Vietnam. She went where she was sent by her Uncle Sam. She's waved from our ships upon briny foam, and now they've about quit waving her back here at home. In her own good land, she's been abused. She's been burned, dishonored, denied, refused. And the government for which she stands is scandalized throughout the land. She's getting threadbare and she's wearing thin, but she's in good shape for the shape she's in because she's been through the fire before. And I believe she can take a whole lot more. So we raise her up every morning. We take her down every night. We don't let her touch the ground. And we fold her upright. On second thought, I do like to brag because I'm mighty proud of that ragged old flag. Folks, we live in America. And so I believe you need to take caution. I believe that you need to take the right measures that our officials are telling you to take, and then some, quite frankly. But in America, we have been through all those things that were mentioned in Johnny Cash's Ragged Old Flag song. We've been through these things before. And 100% of the time, whenever we've had some type of crisis in the market, 100% of the time, the market has eventually gone on to make new highs. Sometimes it takes a few days. Sometimes it takes 15 years. But we have come back. So what I want to say right now is there's so much fear and paranoia going on in the marketplace. We live in the greatest country in the history of Earth. And we're going to get through this. I don't care if you hate Trump or you love Trump or if you're voting for Biden, Bernie, whoever. You're an American, unless you're a foreigner listening to the show. But we're Americans. America will get better. If you don't have faith in Donald Trump, that's fine. America is much bigger than the presidency. That's why we came up with these checks and balances when we formed this country back in the late 1700s. America is bigger than one man. If you believe Trump can pull us through, that's even better. My point is that now is the time to have faith in America like we always have. A lot of us have been through the crisis of 2008. We made it through that, whether it was Bush's fault, Obama's fault. Well, it depends what news channel you look at. I don't care, quite frankly. The bottom line is that I'm 42 years old. And I've been very fortunate in my life from the standpoint that I've never had to sleep out on the streets because of the fact that I have been homeless. I've never had to miss a meal because I wasn't able to get a meal. I've had that, and I'm willing to bet a vast majority of our listeners have had those things happen as well. This is America, folks. Don't panic. Things are going to be good again, even though they really aren't that bad to begin with. So that's what I have to say right now about that. Now, in regard to our economy in general, the people that are going to get hurt through this are the small businesses. Now, they're trying to do some stimulus through small business loans, payroll taxes, things like that. And that can help, but ultimately small business is going to get hurt from this. Now, with that being said, I'm looking at this as a market participant. Big businesses, in the long run, this really isn't going to affect that much. So Apple's not going to make as big earnings this quarter. Ooh, big deal. Apple's going to survive. And companies that are big, ultimately, when the small businesses die because of something like this happen, they don't have enough reserves, they're not as big. When that happens, it's more money for the big business. Now, right or wrong, that ultimately bodes well for the market. So that is my take on things today, folks. We can talk a little bit more market specific in a moment, but I wanted to mention that today.
Uncle Mike putting us all here in a little bit of historical perspective. I never heard that Johnny Cash song. I'll have to go dig that one up. I guess my back catalog of Johnny Cash not as deep as Uncle Mike's here. Mr. Rock Lobster, do you too have a somewhat country wisdom song to share with us? And what else is lighting up your tape and indeed the tapes of the crazies out there, sir?
It's hard to really top Johnny Cash for a country song, especially that song. So I'm just gonna cede that ground to Mr. TOSAW. I like that. I like Johnny Cash. As far as what's going on, historic. So, if you're a student of the market, like I am, you should know your history. And the fact that, remember, we talked about this, I don't know, a month ago, like I cannot believe we are not lower. I wasn't set up massively short or anything like that, but, I had a little curvature. But I was on the show, like, this is not right. A slowdown is inevitable somehow. And now we have it, and you have to be realistic. Like TOSAW said, we either figure out a way to kind of contain the spread because you don't want to overwhelm the hospitals where most of the country survived, sure, which is, I think, the problem at the beginning was that's not the issue. It's having the hospitals being overwhelmed by, older people or people with, previous problems or something like that. That's the problem. So, and to be honest, it looks like the CDC and the FDA, whatever, they're a little slow on the uptake, getting tests out, and I just basically they weren't ready. But we could sit there and armchair quarterback them forever, and it's not going to change anything. It looks like they're trying to get it going now. As far as we have historically had flus. Go back 1918, Spanish flu. A lot of people got laid out on that. Market didn't do so well for a while. This is where we are currently. And eventually, if the economy grows, stocks go back up. Right now, it was at an all-time high. I think we're barely at the level that we were, and I have to look right now, in January of 2019 or December 2018, when we hit some pretty big lows there. So in a lot of even stocks I look at are not even close. Apple is not $150. Okay, it's $250. There's a lot of stocks that are a lot higher than they were kind of in those lows. And that rally last year was pretty big. There wasn't really any earnings growth. There was some, but not a ton. But nonetheless, the market went up. So I think the ship is kind of self-correcting. Things got back to sort of what I would call reasonable prices really fast. The market is incredibly fast at doing that, and it's going to find its level. It was probably a little overcooked on the upside, and now it's a little – I'm not even going to say it's overcooked on the downside, to be honest, because there's a lot of uncertainty. So as far as people in the pit chat, most of my students and stuff, they're long vol. They have a long VIX bias when stuff like this is happening, and then we just kind of wait for the market to move and then take a look. But you can sell, but if you're getting run over and you don't have any money left at this point, you can't do anything. So, but the SPY at like 200, 190 puts, 180 puts, you're starting to get down to levels where you can create things at much better levels. And what I would say is it's an interesting time. You don't have to be in a rush. You try to look for stocks that you think are going to make it through all this. And just be mindful. You don't have to be greedy. I think you still got to be patient. For myself, I told myself I'd buy stock every couple of weeks. And tomorrow is my next time. I haven't bought any since 2 weeks ago. And then 2 weeks from now, I'll probably buy a little more. So I don't know where, and that's what I'm talking about, like retirement account stuff. Trading account is a totally different thing because it has a short delta, so it doesn't matter. But but if you're still a long-term investor, and when the market goes to TOSAW says, never been a better time to sell. Lighten up on some of the stuff that's made a lot of money, take some cash off, and hang out for a while. There's nothing wrong with that. So at this point, I think the Fed is trying. I would prefer if they stopped trying at this point. Let some of the news shake out. Let the market suck for a while. I mean, you got to be. I mean, it's now we're down at some level where it's just going to find a bottom at some point. It will be it could be a low bottom. You could see 2,000 SPX. Who knows? I don't know. But let it find that level because if China is now starting to come back online and some of the other countries that are in worse shape now but get better, they're going to see the path out will be a little more clear. Right now it's very opaque. So, nobody really knows what to do. And frankly, I think this kind of activity should have happened probably a week ago, where everybody took it a little more seriously, got some more testing out there. And you have to be realistic. You're going to go on like a 2-week vacation here where there's not a lot of movement so they can start seeing how many people have it, how they can treat it, and how they can contain it so it doesn't become a mess where like hundreds and hundreds of thousand people have it. So the market is going to be messy. I would say I don't think we're going to see a below 50 VIX between now and March VIX expiration. I think it's going to stay here. We're going to have 3 to 4% swings. If we have one hint of a coronavirus cure or a vaccine, the market is going to rip like 10% in a day. The rally will be disgusting, right? And it'll probably be a favorable rally because they're like, well, we think we have a vaccine, and the market's back down again. So I don't think that's going to change. And you have just a volatile situation, and it's not going to go away anytime soon. I would prefer the Fed just hold on anymore and just, let things find a level. And then as companies need credit to sort of get through, just provide lines of credit. I mean, that's what they've done in the past. That's what JP Morgan would do 100 years ago, essentially. And I think that's we need to go on. But, there is precedent for a huge flu in the United States. Go back and look at Spanish flu 1918, around that time. Market didn't do so well then either. And you just got to get through it and move on. And stocks will probably be lower than they are tomorrow. So just remember that when you're doing anything. There's no sense in being leveraged or really not paying attention to what you're doing. So I think that's what we got. And onward we go.
Onward we go, indeed, with the show. And you're right, we did have a pandemic. It was a wee bit different. I'm somewhat of a bit of not quite an expert, but I know my way around a pandemic or two in terms of analyzing the historical perspective. Go dig back some historical articles back in the day, listeners, about with my name and Black Death, if you want to see what we're talking about here. Way before the options insider days. But I digress as we're heading on into this. But you're right, the Spanish flu was an interesting environment, a little bit different environment that we find ourselves in right now for a couple of reasons. First off, obviously, the massive disruptions of World War I. There were huge troop transports going on, huge dislocations of populations, huge migrations of populations that, of course, fed into the spread of that flu. We don't have that now, but of course we have a much more advanced air travel. Didn't really exist back then, so that could maybe be taking the place of that. And of course also the Spanish flu was much more virulent, much more deadly. And it struck down pretty much a broad swath of the population, including young, healthy men and adults. So not exactly what we're seeing now, thankfully. So some good differences there between what we're seeing now and what we saw back then. Also, the market, obviously a very different beast now, much more involved, much more deep and liquid than it was back then as well. So a lot of things to take into account, but still, there is a little bit of history out there. Looking right now at what the Fed just announced, I was digging into it a little bit more. They're increasing the size of their repo operations, again, to address what they're terming the, quote, highly unusual disruptions in the Treasury market. It's going to offer $500 billion in a 3-month repo operation on both Wednesday and Thursday. It would also offer about $500 million in a 1-month repo operation tomorrow. New York Fed announcing similar levels. This is on top of at least 175 billion in daily overnight repos. So again, they're trying to disrupt, or I should say, address the disruptions out there in the Treasury market. Also, a lot of rumors, hence former staffers coming out and saying they think the Fed's going to go to zero sometime soon. I'm with you on this one, the Rock Lobster. I hope they kind of sit on their hands a little bit because they can't use all their bullets right now, especially as we're seeing the markets kind of just taking what the Fed gives them and just gobbling them up and going right back down. We saw it a week or so ago when they cut by half a basis point and the market kind of just shrugged it off. Now we're seeing this emergency action by the Fed being announced and the market rallying for a bit, cutting those sell-offs in half. Now most of the major indices right back down. The Dow off 6.25%, the S off about 6%, and the NASDAQ closing in on 6%. Gold also taking on the chin, off 2.5%. Oil 5%. If you like all the commodity stuff, don't worry, we'll be coming at you a little bit after this show with TWIFO, This Week in Futures Options. We'll break it all down there. Spoiler alert, energy going to be on there. Equity is going to be on there as well because equity is also leading the dance this week, and metals and a few other things out there that are just perhaps not performing the way anyone expected this week. We'll get to all that in a little bit. Let's see what's performing right now in terms of overall options volume. As of a few minutes ago, we're seeing the VIX. Again, we've seen a few shocks now. We've seen multiple days over 3% in the market, so a day of 5+% circuit breakers triggering. Again, past its prologue, the market has seen this a few times already just this week. So we're not seeing perhaps as much paper as if this kind of just exploded out of nowhere. The VIX closing in on about 750,000 contracts. Again, that's robust, that's very active, but it's not the explosion of paper. You probably see well over 1 million. If this happened out of the blue, obviously maybe a couple of million. We're looking at an ADV right now in VIX land of just north of 1 million, about 1.08 million out there. The SPY at about 4.4 million contracts as of a few minutes ago. Their ADV about 5.25 million. The S at about 1.62 million. The ADV nearly 2 million, 1.99 million. The Qs 1.04 million, the ADV about 1.11 million there, and the Russell, aka IWM, which has been leading the charge to the downside in equity, is going to have Sean on in a little bit on TWIFO from FTSE Russell to talk about all that. At exactly 500,000 in the IWM, the ADV 535,000. And, of course, the most active equity. Actually, before we even get to that, we kind of buried the lead here at the top of the show, listeners, and I wanted to get your thoughts on this as well, Mr. Rock Lobster. We are in somewhat unprecedented waters for other reasons as well, because our friends here across the street, our friends from TWIFO here, aka CME Group, taking the somewhat, I do believe, unprecedented step. Obviously, everything was closed for 9/11 for external reasons. It wasn't a choice by the exchange to do so. This time, CME coming out and shuttering their trading floors, saying effectively we're going to do it out of an abundance of caution for coronavirus. And I think the big question mark for a lot of people is, will they ever reopen? It's no secret CME has been heading that way already for a long time. They've been pushing Globex, and Globex is doing a larger and larger share of the volume every month out there. So CME is maybe perhaps uniquely positioned to do this. It'd be a different tale if the SIBO was trying to do this, trying to take the S, and the VIX fully electronic would be a difficult dance. But CME clearly feels like they can do this. Mr. Rock Lobster, I don't think you ever traded on the CME. I know you were a SIBO guy and PICOs and everything else. But what are your thoughts on CME saying goodbye, at least for now and potentially forever, to the trading floors, sir?
I think to be honest, I think there will always be a floor because people still want to get a quote. I don't know if we've moved all the way over yet. I think for doing a lot of larger trades and stuff like that, I still think that will be there. So I get that. But think about it this way. How about everybody going home from college and then logging on to Zoom and taking their classes? And all of a sudden everybody's like, why am I paying $60,000 for a class I can take online? So I think the biggest casualty of this really is going to be online or college. Like standard, liberal arts, pay a fortune for college. And people are going to like, why the hell are we paying all this money for this? So, I mean, you look at it and you're like, wow, like education can be done virtually. So I think I see the CME, but I think there's also, people are going to look rightly, and there's going to be a college that jumps the gun on this, or they're like, okay, we'll take less tuition, but we'll teach a lot more people and bring them into college via Zoom and stuff like that. So I think
that's becoming more of a trend, though, with colleges. There are a lot more online classes that are happening.
Yeah,
but I agree. I agree. There's going to probably be more after this because right now we have a lot of colleges that are shutting down. I think it's a matter it's a matter of time before most of the Big Ten schools are shut down. I mean, Ohio State's shut down right now. But I think you're right. It is going to hurt colleges ultimately, because another source of revenue for college is dorm room money. And if kids aren't there to stay in the dorms, they can't really rightfully charge for it. So I agree with you, but I do think that online college at a lot of campuses is becoming bigger and bigger.
And I think it's going to be done. Like, people are going to see, why am I spending all this money, for this education when I could just do most of it online? So I think that will be the big casualty, although, I'm sure they'll fight it tooth and nail or whatever.
Well, that would certainly be a good outcome for all. That'd be certainly a silver lining for all of this, right? If we have a collective pushback on the absurd levels of the absurd costs of higher education in this country. If that is a silver lining coming out of this growing catastrophe out here, then that at least is something we can cling to. But yeah, very interesting stuff there on CME. Worth noting, SIBO, which I mentioned, that would be, I think, a much starker, more difficult prospect because, of course, the S firmly entrenched on the floor. VIX also as well. But I think they might be able to migrate that upstairs a little bit easier. But the S still entrenched on the floor there. SIBO dismissing those rumors. There actually was rumors someone had coronavirus on the floor. The SIBO actually taking the step of putting out a notice, a release to this effect, saying there was no one on the floor and we are not closing our floor, which, again, they have much more entrenched reasons to do so. CME has been pushing the other way. But interesting stuff. If we see the S go fully electronic, man, that would be interesting, and also probably be a huge hit on those markets because they're not set up electronically to really handle the size that they're doing and they need to do right now in this kind of environment. All right, let's see what else, talking about size, let's see what's lighting it up on the rest of the market on the individual equity options name. Again, kind of speaking to the fact that we've seen a few shocks now. We're not seeing perhaps as much paper in the individual equity options as you might think. It only cost you $1.23 in terms of 123,000 contracts to break into the top 10 today, and that gets you to American Airlines. Number 9, Amazon, 133,000. Number 8, good old Boeing, our friends across the street. By the way, they're having I think the worst day in their single day in their stocks history since I think 1974 yesterday. A bad day not to be having lunch over there in their cafeteria across the street because it would have been interesting to hear some of the whispers and rumors going about out there. But yeah, a bad day for even worse than the days when the planes are falling out of the sky. Kind of hard to believe, but that was the case. Boeing had 145,000 contracts. Number 7, GE, 170,000 contracts. Number 6, good old Disney. They are, of course, everyone's waiting to see if they're going to actually take the step of closing their parks. That, of course, would be a huge hit for them. They're shy now of the 100 level. That's, of course, the price level a lot of people have been watching. They're at a 95.12 off 10.5 handles, nearly 10%. It seems like at a certain point they're going to have to make that announcement. That would certainly be historic. Also a big hit on their revenue. They have to make refunds and everything else like that. Disney not quite taking those steps yet, but stock certainly taking a beating out there, exceeding the market to the downside, off nearly 10%. 214,000 contracts on the tape for number 6. Number 5, AMD, a perennial top 10er, even a top 5er these days, which is kind of interesting. AMD, 248,000 contracts. Number 4, good old Microsoft, another one. It's perennially in the top 5, not even in the top 10 these days. Not a name you think is coronavirus driven, but doing a ton of paper day after day. 269,000 contracts. Number 3, a day that ends in Y, got to be Tesla in there somewhere. Tesla at 272,000 contracts. Number 2, good old Bank of America, 299,000 contracts. Number 1 with the bullet is our old friend, the fruit company, 718,000 contracts on the tape as of a few minutes ago. Looking at him right now, and Mr. Rock Lobster alluded to, in all this turmoil and all this madness, Apple still over 100 handles north of that 150 level, where everyone in our audience, everyone on our network was kind of wringing their hands saying, I don't know if I want to sell puts at that level. And here we are now, still 108 handles, almost 107.5, just ticked down handles north of that. We're at 257.5, Apple down about $18, about 6.5%. So also outpacing the market ever so slightly to the downside. Of course, they're having the 1-2 punch over there of demand issues with China being mostly shut down, also production issues with China being mostly shut down, and of course all the other restrictions coming in. Demand's going to take a hit across the board, you would think. So Apple leading the charge here to the downside. Let's look really quickly and see where most of our biases are lurking here in the paper. Usually this top 10 is heavily biased towards the calls, mostly biased towards the puts here this week. Looks like 71% on the put side for Disney is our number one biased. Number 2, hot on his heels, American Airlines. Number 2, 70% of that flow coming on the put side. Are any call bias? Microsoft actually is still biased towards the calls with 63% of its flow on the call side. So folks still liking themselves. Let's pull up Microsoft here really quickly. Mr. Rock Lobster, I know before we get into the odd block, and it's kind of a weird day, so I think we can maybe dispense with our usual format for a little bit. I know you're a big watcher of Microsoft of late. I know you traded up a lot. Do you have any idea why it's doing so much paper right now, and it has been for weeks now, and when everything else is pretty much Corona-driven?
Well, one thing, their software cloud business, it's the only thing I could think of is it was a market leader. It was it wasn't officially a FANG stock, but it actually was one of the great performers. I don't know if you remember, Microsoft was a $20 stock in 2011. So I think it had a lot of I think it has a lot of fans. Now it had the multiple, I have to say, got a little, it got pretty darn crazy at $190. But I think there's a lot of I think there's a little recency bias, right? Like, okay, it was just there, and a lot of buy the dip, and the buying the dip isn't working. It's not working, hasn't worked in the last couple of weeks. So I think that could be part of it. And I think the multiple now is getting to be quite reasonable. If it gets back down to $100, I'll probably buy some more of it. So it's one of those things where what I was telling, the pick crazies today or some of my students is, hedging with VIX is easy. And if you want to sell puts and stocks, think of a crazy price and then find one, and then go lower, because there's a bid for a put almost anywhere. Like, just take your pick. Disney in the 60s, 70s, those puts were like in the $2-3 range for April. I'm just saying, when you think about it, I'm trying to be realistic. This coronavirus thing, it has a lifespan. It appears. So, so the country takes a vacation for a month or whatever. I don't know. But, you're starting to look at some of these stocks that are, 50, 60, 70% off their levels. And they're very interesting. VIX call spread wise, there are a lot of in-the-money call spreads relative future to cash. You guys will probably cover that tomorrow. Make really interesting hedges, so you can have sort of what I would call like a short vega long vol. Your long vol in the front and short vol in the back type of portfolio, and you could survive stuff that way. So there's ways to do this. Microsoft would be an example. Because, we've been through a lot of markets, right? And there's no price on this screen that I see that is not possible within the next 2 to 3 weeks when VIX is at a 65. There's no price that's not possible. So the Fed can do all they want, but if there's no, the liquidity dries up, right? Now, I am seeing the vol reduce somewhat, even though SPX looks like it's going to be ripping down for a 10%. We're going to hit a 10% stop again today. But, you have to think, you've got to think a little ahead. You can't be looking at what's now and just where the stocks were, right? You have to think about where they're going. And at least for as of right now, until there is more clarity, they're most likely going down. I don't want to be a Cassandra-ist, but I've been kind of like that anyway for the last 4 weeks, so why change? And you're looking for interesting prices. That's all. And look to prices where you don't think they could get to. And you'll probably find more opportunity in that area, I would say. So Microsoft is definitely one of those. I don't see 190 anytime soon. I don't even see it in the next 3 months. But, remember, there's a lot of liquidity sloshing around now, and there's a lot of money to be made creating some kind of solution for the coronavirus. So those are very powerful factors when everybody sort of gets their head above water again. So, right now it's going to be crazy. You don't want to blow yourself out. TOSAW is a great example of, just managing your game. I manage my game by trying to be long vol and basically have a sort of a back spread going. But everybody has a way to do it. But where you are at this level, there is opportunity if you keep your head about you. But like I said, think of a crazy price and go lower and see what's there.
There you go. Good rule of thumb. Good words to live by. You want to sell a put? Think of a crazy price, and then go lower. Just go lower. Like I said, we're probably going to dispense with our usual format. That a lot of you guys have crazy questions. I think we're going to get to more of those in a second. Just looking at what our Eye of Sauron is picking up for us right here. Actually, surprisingly, this kind of gets to what I was saying earlier, maybe about some of the systemic shocks we've already endured. Not as much lighting up. Our Eye of Sauron actually struggling to find some interesting papers. Some of the biggest prints of the day were all in one name, actually. We got CIM. This is Chimera Investment Corporation. This is a REIT trading about $15.35 right now, ticker symbol CIM. We saw huge prints. This is the short sale restricted name of 10,000 lot, a 6,000 lot, and a 4,000 lot of the June 13 puts. So $2.30 out of the money puts there out in June. Going up for around $1 to 95 cents. Again, a total of about 20,000. This is the name that doesn't do a heck of a lot of paper. I don't have the AD in front of it, but I'd say probably a tenth of that, if not less. So someone drawing a sizable line in the sand, it seems like, out there in SIM. But outside of that, not a heck of a lot out there on the old Eye of Sauron. You guys have a lot of questions, so let's keep on rolling into the old mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right. A lot of you writing in, chiming in about Cramer's meltdowns here. Cramer, of course, chiming in this morning, actually having some dramatic theater, getting a call from the quote-unquote White House. I'm not sure why there's a phone on the set when he's talking. Obviously, maybe this was pre-planned. I don't know. Maybe his buddy Kudlow, obviously the one making the call. But either way, he's been calling for bailouts and buybacks and the federal government backing in on the liquidity side. Folks saying he's becoming totally unhinged, all this madness. Jim Cramer rant, begging for government interventions and bailouts. They say pleasant things about him here, which I won't read. It's a family program here. I'm sure Mr. Sebastian has some thoughts. That's his buddy out there anymore. But before we get into that, interesting stuff here. You can touch on that if you want, Uncle Mike. Also, we got a question for you here from Angel. Angel wants to know, does Uncle Mike still have his short puts on right now, or is he canceling all bullish equity trades until all of this calms down? Also, for his broad equity portfolios, does he always have a hedge component, or does he only put them on selectively depending on market conditions? So, Uncle Mike, if you have thoughts on Cramer's somewhat epic rant this morning, have at it. But also, more importantly, from Angel, what do you have to say for Mr. and perhaps Mrs. Angel out here who wants to know about your positioning right now, sir, and indeed your positioning in your normal markets?
Got it. Good question. I'll leave the Cramer rant. Andrew can address that one. I actually haven't seen the Cramer rant as of yet, so I can't really comment on that. In terms of positioning, for the general equity portfolio, the one that I typically will pitch to clients or put clients in as our strategic night portfolio, a couple weeks ago, George and Chris managed the equity section of that. And if it's, I'm actually agnostic with that portfolio. I'm not involved in that one, but they're part of the team, so to speak. They manage the equities. They actually went to 20%. They went to, I believe it was they went from a 90% equity stake with 10% cash to 70% equities with 20% in TLT a couple of weeks ago. And that's in the equity-only portfolio. So that one's actually faring extremely well in this downturn, just from TLT just going up through the roof. That's a non-option portfolio. Within the hedged strategic night, that's where I am at right now. What we have on is what we refer to as kind of a baby hedge. And so we were hedged from, what we did is as of this year, we had a long-term hedge on from 335 in SPY, basically the top, all the way down to 259, which is where we just crossed through today. For the time being, we're not going to mess with that hedge at this point, just because of the fact that we also have TLT in there acting as kind of a hedge, so to speak, or not a hedge, but some relief. So we'd have to drop a lot more before I rolled down the put. In the past, we have rolled down the put, but we've gotten to our line in the sand much sooner. So not much sooner, but we hit it where we would not have any TLT exposure, or we had more equity exposure. So for the time being, we're going to leave the line in the sand alone, but we're meeting every day on it.
Looks like the Skype gods not smiling on St. Charles. We'll get Uncle Mike back here as we go out here. Comment from Davey. It's kind of interesting one from Mr. Davey. He's saying, guys, I'm buying straddles in SPY and Qs, and they're actually working. What the heck? Long straddles. Who knew? Yeah, actually, Dan Passarelli and I were chatting about this yesterday on the Options Bootcamp. You asked for it to come back here. We brought it back for you. It's going to be hitting the network soon. Hopefully, if you listened to the live stream yesterday, you already caught it. If not, it'll be hitting the network, the podcast. We just have so much stuff going on. Getting all these shows out to you is challenging here. But we were just talking about this. In fact, that's one of the 3 recommendations Dan had for trades in this environment is a long straddle. And I was teasing them, but we were both kind of joking, like, how often do we ever say that? In fact, someone else wrote in about long straddles, I think a week or so ago on the show, and I was joking about it then, like, what's a use case for them? And I said, now is kind of the textbook use case for a long straddle, because most times long straddle you're buying 2 at the money options, so that's where the implied vol is going to erode the quickest. You're going to have the theta coming in the fastest, and as a result you're going to see those options decay. So usually decay is going to kill you buying a straddle, and they're expensive to begin with, and it's eroding quickly. So you're buying this rapidly eroding asset, usually not a good play. In this market, even though they're very expensive, we're seeing 3 to 6% moves in the S&P. The straddles are actually paying off. You could scalp to the downside, maybe scalp to the upside, or just put them on unidirectionally, and it's working out that way as well. So yeah, I'm with you, Davey. This is actually one of the few environments where you're not going to hear me mock long straddles here. Mr. Rock Lobster, same question for you, sir. What do you have to think about just, hey, buying straddles? It's working right now, huh?
Yeah, I mean, if followers of the Vol Trade Club, we in the morning, the 1 week trade, or what I have kind of what I would call a fast trade for people that can trade on a daily basis, and then sort of a monthly trade. That's kind of a different move. But in the morning, I said, every time you have a vol pullback, we just went over this last night in the class, every time you have a vol pullback when VIX is this high, it's a local pullback, short-term pullback, and what you have is a long-term huge vol market. So the vol products, buying strangles in the vol products like VXX works very well. I just closed them this morning. Also, SPY or SPX, take your pick, depending on the dollars. Close some of that too. And just because, one of the things in a market like this is when VIX is in the zone of the month, zone 1, straddles are kind of overpriced. Even though vol is cheap, nothing's moving really unless you have sort of that bull rally that will drag the gamma up, drag your calls basically upward to make money. But usually they just kind of die, especially like a 30-day straddle. Here, you're looking at straddles that are, no more than a week long, and you're not holding them for more than 1 day. You put them on and then you take them off. So it's not for the faint of heart because, you're buying like $20 or $18 worth of premium in the SPY. But remember, you're not holding it for 5 days, right? Unless, you get kind of a runner in one direction and you want to run the delta down. If you have expanding vol, theta is arrested. So even though things are high, usually what I'd say, realize, options are kind of underpriced when VIX is in zone 4, which we are well into at this point, about as high as we've ever been. And options are overpriced generally in the short term, that is, in zone 1. And I can't disagree with it because that's what I do. My vol trading club people do it. And I have to say, it's been a good, it's not as much fun making money when there's so much misery in the world, but we've been leading people along the way of it's not a time to sell vol. I'm just saying it's high, it's crazy. But it has not been a time to sell vol. So there you go. But I do agree with that 100%. It's an opportunity that doesn't come around a lot, but that's what it is.
Not been time to sell vol. Speaking of which, check your Twitters, Mr. Rock Lobster. Scott Nation's taking umbrage at your suggestion here to that selling puts is easy right now. Mr. Uncle Mike, I think we have you back, sir. We kind of lost you towards the end. You said you had strategic night was about 20% in TLT, and that you were debating what to do with that line in the sand put. Then we kind of lost you, sir. So if you had anything else you want to add, feel free.
Yeah, real quick. And we'll likely do nothing with it just because of the fact that George and Chris, our stock pickers, they're taking risk off the table as we go down. So we're likely going to do nothing along those lines with a line in the sand put because we're in a short, long put spread. In regard to covered calls and short puts, we're going to do one of two things. We're either going to just sit and do nothing because come March expiration, we're going to be long a lot of stock. We actually are. And what we're looking to do is either stay in it and do nothing and hold the equities for a month or two and see where they go because we don't want to sell a ceiling on stocks that have been depressed so quickly because then the stocks bounce back and then we look like idiots and then people say, why are we trading these options? Options are stupid. Buy high and sell low. We don't want to put ourselves in that position. But on the flip side, we still want income. So what we plan on doing is either what I explained or sell a call spread so that way we can get some income, but still get upside if they bounce back right away.
There you go, sir. Yeah, Mr. Rock Lobster. Been on the show before, not on this show, on our Valview network a few times. Scott Nation's doing all those Vol products. He's taking umbrage with your comments. He says your comments, the selling puts is easy right now is dangerous because you left out the most important consideration. You have to be willing and able to buy the stock if it's put to you. Make it sound like a put seller is trying to dodge a bullet. This is the danger of Twitter. Sometimes sarcasm is missed. I think Mr. Scott Nation's.
I gotta fix the frickin' tweet. It's like. When I say it's easy to do, that means you can trip over yourself and sell a ridiculous put. That doesn't mean you should do it. You should be looking at a ridiculous price and then go lower. It's like when I say selling stuff is easy, that means that no matter where you look, it looks tasty. And that's exactly why you should be thinking, oh, wait a minute. I can be more ridiculous in my sale than it actually is right now. But I guess he did miss all that, so I'll ride his ship here. And now I got to. That's why I don't even bother with Twitter. It's like such a pain in the ass. Now I got to deal with it.
Don't worry about it. We'll take care of it for you. We'll talk Scott off the ledge there as we keep on rolling here. Yeah, we're coming up against the end of it, so we got more questions. Maybe we'll do another special. We did a Q&A of Option Bootcamp already. Maybe we'll do more kind of special Q&As as CNBC would put it, these market in turmoil type times may merit these types of interventions on our part as the Fed pumping in more than $1 trillion in their own intervention. As we keep on rolling into our final segment, it is time to go around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block, the portion of the show where we tell you what we're watching. And as you said, there's a lot to watch, a lot to digest. Markets changing, moving, rocking, and rolling minute by minute, second by second. It seemed at the start of the show maybe the worm was turning. The markets had gone from off, obviously, at 7% to trigger the circuit breakers on the morning. Then they were down about 6 and change, close to 7. And then, of course, the Fed stepping in with their $1 trillion repo program here. Markets turning down, cutting the losses about in half, down to about 3.5% or so. And now the worm turning right back down, kind of like we saw with the Fed and their half a point cut last week. Market kind of just digesting it and then continuing to sell off. The S&P off nearly 7% right now. The Dow off almost 7.5%. NASDAQ off 6.75%. Gold off 3%. Oil off 6.25%. I mean, it's just WTI threatening to break through the 30 handle to the dark side. You want more of that? Stay tuned for TWIFO in a little bit, listeners. But before we do that, let's go around the horn and see what everyone else is focusing on. Mr. Uncle Mike, let's start with you. Are there specific levels in the S&P? Maybe you're talking about that line in the sand put. I know you can't really give strikes due to your compliance restrictions, but maybe if you have some thoughts there on perhaps where you'd start changing your outlook here, and also anything else you're watching for the rest of this week, sir.
I got to be honest, if it wasn't a risk reversal strategy, if I have to roll down the short put one more time, I'd almost just say, you know what, let's just sit on this and let it get put to us. But I'm not going to do that. But that's something that I would strongly consider. And so, to give you an idea of it, S&P 2000, it's not out of the question. 500 points, that's nothing for this market these days. So there's going to come a point to where America and the world is just going to say enough already. Let's just buy. What's that point? I don't know. But at some stage, the fact that we've had a 30-point range over the course of the last month, or a 30% range over the last month, pretty much. It's at some stage, buyers will come in, but I don't know what that day is. But for now, I will reiterate what I said at the beginning of the show. We've been through the fire before. America can take a whole lot more.
There you go, Mr. Rock Lobster. Same question for you. Are there any key levels you're watching in VIX land or in S&P land or any other land for that matter? And also, maybe if you have thoughts on this Fed intervention, which I know you're not a fan of, diehard libertarian that you are out there, and anything else that's on your radar for the rest of this week, sir?
I think the Fed should stop right now. I say they've done the liquidity thing. I don't think they should cut anymore. When they have their next meeting, they say, okay, we did the cut early. We're going to see how things go, see how all this stuff is coming, and then see how the coronavirus containment goes. And let things play out. Let the market get stupid. Eventually it gets to a stupid price and people stop selling because, it's not like everybody's cash that they are sitting on is just dried up and gone away. So I think I would, instead of trying to fix everything in a week, it's not a 1 week thing. I think it's a multi-week thing. You're going to see how South Korea looks on I believe around the 20th, because that's about a month later when they went into intensive sort of containment and testing and see what the results were. And you're going to get, from a modern nation like South Korea, what the results are when you really get your act together and start trying to deal with it. So I think we still have 8 days to go on that before we get any kind of answers that are usable here. All you're getting is, little dribs and drabs. So to be honest, I think there's more vol to happen. Nothing will surprise me. Like I said earlier, apparently they missed the sarcasm of my tweet, but what I'm trying to say is no price is surprising right now. Like if you're looking at an equity, no price is surprising. Even if you think it's a stupid price, it can get there. So just be mindful of that fact. So apparently I have to not be sarcastic so people can understand that. But, be careful. You have to be careful and understand exactly what you're doing. Like TOSAW is saying, you expect to have to be put if you're going to do it, even at a ridiculous price. It's my same rule for selling puts, and it's never going to change. Only sell a put where you can take delivery on and you got to be happy with it. And with a market like this, most people are not going to be happy taking it at a level that's a lot higher than it was 2 weeks ago. So
got to be willing to take that pain in the near term. You can sell a strike, you're right. You sell a put, even as your sarcastic comment said, it's easy. Find out each strike and then go lower. You can still get put. Obviously, we're seeing crazy levels across the board here. So that's why I like to recommend, so maybe some people are still a little scared about catching that fallen knife. Some ways you can do that. Get a little bit longer to the downside and also have a little bit of cushion, things like a ratio put spread instead. So you're buying one, selling two at a farther out of the money strikes. That gives you a little bit more cushion if you are indeed off on your estimate. You blow through your strike a little bit. You still got a little bit of cushion. You got a little bit of profit from that long spread. Again, you're not going to make as much money from a premium perspective as just selling the put. But if you're worried about catching that fallen knife, and in these environments, who isn't, that might be an interesting way to go. Check out our Options Bootcamp episode. We talk about some strategies to use in this environment. Of course, that might be interesting for you. But of course, that music means we're done, at least with this show. But if you need more in your ear holes, as markets are still melting down, don't worry. We got you covered. We'll be back in about a half an hour with Twifo. Also have some fun live stuff. If you're listening live, we'll pump that into the stream too for you guys as well. Maybe hedging a pandemic or some S&P flies out there. A lot of good stuff we can pump in for you. We'll be back in exactly half an hour. Before we do that, let's go back around the horn, check in with each of our cohorts. Uncle Mike, sir, I can't imagine a market, an environment where someone might need Uncle Mike more. If they are so inclined, they need your services. They almost want to call up, have a shoulder to cry on. Where should they go? What should they do, sir?
Call me. Go to my website, stcharleswealth.com for more information on that. And, if you're thinking about moving, don't think that, with all this craziness, I don't want to do anything. You can still talk to me. Feel free to talk. And if your advisor was unprepared for such a thing, then give me a call, because I was.
There you go. If you call up your advisor, say, hey, do you use options? And they laugh. That's when maybe you want to fire them and call Uncle Mike. All right. And Mr. Rock Lobster, I can't imagine a better time to want to join a cool, fun thing like a vol club if I was so inclined, sir. Also, I think you have a webinar coming up, so why don't you plug that as well, sir, because that's pretty timely as well.
Yes, go to the Option Pit website, and I hope that webinar is up on our homepage somewhere. Oh my gosh, it is not. So anyway.
I thought you were doing it tonight. You did it yesterday?
We are doing it tonight.
Okay.
Send me a note, Andrew@optionpit.com if you want to come. And I'm not seeing it on our website right now. But it's a huge event. We sent out a lot of notes already. If you want to join my vol trading club, we're like 10 for 9 this year for trades, keeping people on, good straight and narrow, and, teaching them how to trade vol the right way. So it's been a great year for the vol trading club. And pop on by, Andrew@optionpit.com if you have questions.
There you go, optionpit.com. They have that webinar coming up. We tweeted out a link to it. You guys can head on over, as Mr. Rocklofter said. It should be there available if you want to register. OptionPit.com is the place to go. Trading in this environment, everyone needs a little bit of help. OptionPit.com is the place to go. And on behalf of the Rock Lobster and Uncle Mike and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing. Uh-oh, I coughed. I have to self-quarantine. But we'll be back in a little bit here with Twifo in about half an hour. Give you some fun stuff in the live chat in between. And then, of course, we'll be back tomorrow, 1 p.m. Central, 2 p.m. Eastern, with Volatility Views. Going to have our buddy, Mr. Simon, joining us there as well. Should be a fun one over there, the creator of Spikes. So a lot to unpack there, obviously, on the vol front as well. So Twifo in a little bit. Vol Views tomorrow. Option Bootcamp going to be hitting the feed pretty soon as well. So a lot of good stuff for you guys to sink your teeth into. And these days when everyone's self-isolating, self-quarantining, maybe need a little something to listen to, enjoy, learn from, we got you covered. And we'll see you back here for Twifo in a little bit. Otherwise, back here tomorrow for Volatility Views. And it all kicks off again on Monday for more of the Option Block.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.